Welcome to our second workshop session. This is again our first workshop at Vyzer, and we're super excited to kick off the second one because our first one last week was, I think, super successful, and the feedback we got from everyone was amazing. So just again, giving you guys a quick background. I'm Litan. I'm the co-founder and CEO at Vyzer. We help passive investors keep their investments passive using automations and AI to automate and track all the passive investing world. But it's also important to learn how to better invest and go over deals and understand what we're getting into. And that's why we have our awesome workshop leads. Hans led our last session, sort of giving the background of vetting deals, going over the fundamentals, terminologies, and then that checklist that he shared. And today, Mike is leading the second session, which is taking all that we learned in the last one and trying to implement them, going over some actual private equity real estate decks. So that's the objective of this session. Like last one, it's really amazing if to keep this a dynamic, interactive session. That's why we're all cameras open and it's not a webinar style, which is us talking. It's everyone's open and everyone can sort of butt in and ask questions, either openly through video, chat, Q&A, or whatever you guys want to do. Again, we're going to share this at the end of the session as well. And we hope this is going to be another amazing session. Hans, thank you for the last one. I don't know if you have anything that you want to add. And
I'm good. I'm ready for this one. Looking forward to diving into these decks.
Awesome. All right. So Mike, take us away and let's have a great session.
All right. Sounds good. Let me share this deck. All right. Can you see the Bloom Henry Capital deck?
Yep.
Okay, great. So this deck is not one that we did have several really good decks submitted, and we're going to use one of those for the second example. We're going to have two examples today. This one is not from what we admitted. This is actually coming from a deck that Hans and Litan and I have reviewed in the past for our pitch deck podcast. And part of the reason for that is because you have to have sign off on to go over and kind of talk publicly about things. And this deck is one that has some gaps in it. And so we definitely wanted to make sure that we had good, legal, justification to kind of have some not all positive comments on this deck. So first page, typically with this, there's not a lot there. One thing that I would notice with this is that there seems to be two separate groups here. You've got the Bloom Wealth Partners and then the Henry Capital Group. Hopefully they explain that down the way, but that's something that you always want to look at. Legal disclaimers. In general, people gloss over that, but one of the things to remember with all decks, not just this one, but basically this is very clear that all of this stuff is just, it's their best guesses, it's made up. And what your job as an LP is to figure out, did they do a good job? Are they, most likely they're going to be off. Are they going to be likely that they were conservative and that if anything, it's going to hit their expectations or be better? Or does it seem like they're missing things or wildly optimistic? But just something whenever you see the disclaimers to kind of look at that. A little bit about what their mindset is and things, kind of some fluff stuff here, company overview, their mission. And then this is kind of the first spot where we get into some details on it. So this is the Bloom Wealth Partners. It looks like we've got two people that are running that. And then with this, we've got two managing partners. What we try to look for is sort of what's their history. Why are these people the ones that you want to give your money to do the investments that you're going to trust to find the deals and go with it? And I would say this, they're a little bit light on sort of their direct experience. And it's also a little bit light on sort of explaining to me as to why they're ready to take something like this on. So this guy is talking about how he did 150,000 into 6 million, but no real explanations on that. He's managed some construction projects, which is good, but it was in residential, commercial, again, kind of light on the details and how it crosses over to this. And then managing partner over here, I see this kind of stuff sometimes where you've got like $1 billion in deals underwritten. Underwriting a deal is really not the same type of thing as actually getting in and running things and looking at it. So I would just say here again, you got 10 years in residential real estate, but you're talking finance and different things like that. So I'd want to know a little bit more on sort of why they have the background to trust them to run this. Then we've got the overview of what Brandon is with Henry Capital. Again, talking about him raising money for charitable contributions and different things like that. Again, having some underwriting experience, but that's really pretty easy to get. I mean, I could underwrite one deal and get 300 million of commercial real estate type thing. So I want to understand more from these guys, kind of why they're ready to take on this kind of project and why I should be giving them money.
I want to just say, if I can, Mike, one thing on that. I think it's important to emphasize that it's okay for there to be two different companies on the same deck. It's pretty common, right? You'll see a capital raiser that's helping an operator raise capital for a deal, and that's fine. I do think, one of the things you want to see in something like this is also if they worked together in the past, and if they have, how did that go? Because there's no mention. This is the first time they're doing anything together, or second, third, fifth, whatever.
Exactly. The other thing is you want to know, are they coming in and just raising capital and then moving on, which is somewhat hard to do in a legal standpoint, or are they really part of the team and is bringing in the person that you're going to be calling if you have questions, 3 years from now about this deal, and you're going to be getting your updates from him versus one of Scott or Sumit. So yeah, understanding that role and how they
I think, one thing I'd like to add, what we're basically getting at here is there needs to be direct multifamily experience. This is a multifamily deal. So there needs to be direct experience with a track record of deals that are just like the deal you're looking to invest in. It needs to be direct and obvious. And honestly, it's not direct or obvious on any of these bios if they have true multifamily experience per se. Now they may, but it's just not clear in the bios. And then one other real quick comment is you got to watch out for what are their other companies. Like one of these is a CEO of a different investment firm called Real Acquisitions there on that page that you're on. And so nothing's wrong with that. But again, then you need to ask that question as an LP. What is Real Acquisitions? How much time does that take? Does that take away from your role at Bloom Wealth? Those are the kind of things you need to think about when looking at these bios.
Right. Yeah, and some more details on what their bios are, but again, like Hans said, kind of light on specifics that we know that are related to running this type of project. There's a couple of places in here, and I'll talk about this more later, but they're calling it a fund. But when we get down into the deck, it seems as though they're presenting it as a single asset deal. And so there's sort of some mixed language throughout this where they keep calling it a fund and acting as though this is some sort of an overarching fund that's going to have a lot of these deals, but yet they're presenting it as a one-off where it's a specific syndication for just this property. And then this sort of advisory board, this sort of thing is, it's great to have, but there's really not much information there or really telling me how that's going to help that much. Again, they're talking about a fund here and sort of talking about what they're looking at with the fund. But then when we get into the details on this, it's pretty clear that it's just a specific property that they found.
Did you say like what it means to have a fund versus a single deal? Did you say a word about that just because to emphasize the difference?
Yeah, absolutely. Yeah, a fund is where you've chosen your operators and they are going to go out and they're giving you their plan. So for example, they may be raising 10 million and they'll tell you that with that, they're planning to buy 5 to 8 properties that fit this specific buy box. And maybe they've identified their first property or second property, or maybe they've got many of them, but you would know some of what they're looking to get, but you're giving them a wide range of latitude to sort of buy things within that box of what they're looking for the fund. The nice thing with that as an investor is you get diversification. And so even a really great operator, you're going to have some of their projects better than planned and some go worse. And so as an example, I invested in with an operator last year. They've got, I think it's 7 or 8 properties. One of them is lagging. They've got 4 that are doing really well. And overall, the fund is doing better than expected. But if I had invested with that operator and just the one that happened to be the one that lagged, I'd have very disappointing results at this point in time. So,
well, yeah, I'd argue that diversification is a strategy. It's always a good strategy. It's a strategy that people look for. You're lowering risk. You're also lowering potential returns because you're diversifying.
It also takes a lot of trust, because you can't judge for yourself if this is a good project or not.
Right. So basically, yeah. So what you're saying is basically a fund is across multiple deals, and a single deal is basically they're just pitching one deal, one property. And what we're seeing in this deck basically is that the beginning starts as if it's a fund, like they're raising a fund to invest in multiple deals, but we'll see in a second, this is actually just one deal. And so I think that was a good way to summarize it.
Additional benefits here, they're talking about tax efficient depreciation, long-term capital gains. Those are all things that are good, but we need to kind of get the specifics on this. There's a lot of this kind of fluff in these slides that don't really give you any sort of details on it. Now, at this point, we're getting into the actual property. So when they're presenting it for the rest of it, they still call it a fund a few times, but it seems as though this is a single asset deal that they're raising for, which then this is where we start to get the details on it with this. So we know that it's built in 76, it's multifamily, where, we know where it is, and then what they're going to plan to do to it. A little bit of an overview on the property. So we've got a 69 unit garden style. One of the things that I would show that is good with this is that the property built in 76 and it's still owned by the original family. When you're looking at a deck or any sort of plan, you really want to understand what the value add opportunity can be with this project. And in a case like this, where it really has been in the same family for a long time, it is possible that you get to where they get kind of lazy and they don't keep up with the rents, or they haven't done put the capital in to really improve it. And so this is a good potential, and something that you really want to look for with any deck that you're looking at is sort of what's the real value add plan, and is there potential with that. Breakdown of the units, and then a little bit more on sort of average in place rents and things like that.
I would like to make one comment on this slide here. They mentioned $148 in rent increases, but there's no comp set provided. There's no slides provided showing why they can get $148 in rent increases. There's no comp sets at all. And so, that's to me, it's a red flag there.
Yeah, we're really light on the details for the plan. And you'll see as we go through our second deck, just the vast difference between a deck that gives you a lot of details versus something like this where they're really not giving you much at all. Another slide on sort of what they like about it, why they're doing it. One thing with this temporary price dislocation, you'd really want to understand what that is about. If it is something where there's a death, there's a divorce, there's some sort of weird thing with another property and they need to raise money quick, that's one thing. But what I'm seeing a lot of now is where they're saying it's a temporary price dislocation, but all it is that the market is reset from the peaks. And so, yeah, it's 25–30% less than what it was a couple of years ago, but that doesn't mean that it's not, fully valued at this point in time. Another thing to look at here is that they've got a very wide range for their average annual return, 16 to 25. A lot of times you'll see somebody list sort of what their expectation is, and it's not uncommon in a deck to sort of have a best case, worst case scenario, base case. But yet with these guys, they've got this wide range and with no real explanation. We'll get to it later, but it's not a good explanation. And then the other thing is average annual return versus IRR. Really, there's a difference with the IRR giving you basically valuing getting your money back sooner and how long they have your money before you get it back, versus average annual return does not do that. And you'll see usually either if it's an unsophisticated operator that doesn't really understand IRR, how to calculate it, or if they're trying to do a project that you're not going to get your money back until basically all of it's coming at the end, the AAR will be significantly higher than the IRR. So sometimes you'll see somebody using average annual return just to sort of make it look better that way. A little bit about the project, some highlights on the property. This is something that, is nice to see, where you want to see where your property is compared to other things. This isn't the best map, but it does give you a little bit of an idea. This was a little bit hard to see, but you can kind of see, I think they've outlined down here in the bottom that that's the property. And so it is in a general, area where there's things that people can get to. But you do want to get an idea always of that. Then pro forma. One of the big things that I worry about with this is this huge rent increase all in year one. So they've got, basically the entire amount of the rent increase happening right away. And unless you've got a situation where everybody is on month-to-month leases and you don't need to turn over the properties and do any sort of value add to it to have things there, this usually is going to take it a lot longer than that to really get the full rents implemented. So this seems very unrealistic and kind of a lack of sophistication with it. The other thing that they're not showing me that I often would look for was what was the vacancy rate that they're using. And if you calculate this, they actually have a 0 vacancy rate in year 0 and a 99.2% occupancy rate in year 1, which is completely unrealistic, even if you're not doing a value add, but certainly with a value add, that's not the type of thing that you're going to realistically see. So there again, it just sort of tells me that these guys don't necessarily know what they're doing, or at least it makes me worried about it. Just kind of a lack of experience on how to prepare a deck and how a project like this would, realistically come through. Another thing that you
One comment I have, one I wanted to add there is a simple way to look at this is if you look at year 0, which year 0 is the actual net operating income of, I believe, what is that, 201 or so. And then year 1, which is their first year of ownership, it increases drastically, like to 323,000, I think. It's basically increasing over 60% increase in year 1 NOI. I mean, that right there immediately tells you that this is definitely a red flag, very unsophisticated underwriting. And because there's nothing in this deck that basically proves out that they can increase net operating income by over 60% in a 1-year operation in a deal that, has long-term leases. You can't turn over, like Mike said, turn over every lease immediately. So it's just that one simple calculation would tell you that you probably wouldn't want to invest in this deal.
Yeah, another thing that shows me that they haven't thought through their plan well is things like taxes. For example, you want to make sure that they're looking at it as to what the current tax assessments are and then what likely they're going to go to once they own the property, and at least have something spelling that out. And this is a very just straight line, percentage going up. Same with insurance. We're seeing a lot of insurances change drastically. And I would want those sorts of things that they were accounted for and talking, and explaining why payroll and insurance and things like that are going to stay the same or what their plan is that they wouldn't. So just a general lack of giving me the impression that these guys know what they're doing and have a well thought out plan. The next thing we get into something which is good is that they're showing an example of something that they've done before that's very similar and how they did it, that they did a project like this, that they brought it in under budget, that kind of thing. And then identical cardinal style. Hans, I'll let you explain cardinal style because you understand that better than me. But again, it's a specific type of building that can have some issues. So it is good at least that they have some experience with that.
Yeah, it's modular housing that was done back in the 80s, and they're known, if you were not in the industry, you wouldn't know this, but they're known to have a lot of repair issues. So you must be very experienced. A lot of people that would buy Cardinal housing don't budget enough for expenses and deferred maintenance to take care of these type of build outs. So that's the reason it's kind of a big deal. But it's not a be all, it doesn't kill a deal or not kill a deal. It's about experience. There's many other factors in this deck, I think, that are more important than that part. But that is something that, again, as you get more versed, you start seeing things like this and to ask questions. It's always about asking questions.
Right. So some good things here are, again, that they're showing what they've done before and how the last one played out, and then what they're planning to do in the London Square details and that sort of thing. So that's all good things. Getting into their track record. So sponsorship track record, with the asterisk. Well, one of the things that they've got in several of these slides is the asterisk is managed, controlled, or owned by Bloom Wealth Partners principals, which is just, it's a little concerning because it doesn't really explain to us, were these guys the GPs on this? Were they just asset managing for somebody else? What was the example here? I mean, they give 5 full cycle deals, which is great. But when we get down to their track record, they're only showing 3 that have actually sold. And so it's like, where's the other two? And then of the 3 that have sold, they don't really, again, give you the details on were these things that they ran and they owned, or were these things that they were just involved with by maybe being the asset managers, or did they do construction on it or something else? So a lot of sort of vague language that makes me question how experienced they really are with this type of thing.
I'd like to emphasize one important thing on this, all right? Just like high level. It's okay investing with people who don't have experience, but it's just important that invest with people that are transparent about it, and that's fine. I think like it's just really important. You know, when they put in such small fonts, it's like, wait, they're showing me these big numbers of AUM that they've done, full cycle deal that they've did. But you know, in the small print, it's like, well, they didn't really do this as GPs, they did it as other things. But sorry, just say that up front. I think that's really important to emphasize.
Mhm.
The next slide that makes me question what's going on is that, I mean, one, again, we don't know, are these projects that these guys are running and have done all the way through, or is it just things that they're involved with in some way? But in their examples, we've got a couple of hotels, a retail, a multifamily that's in their portfolio, and then 3 multifamilies that have been sold. And it just sort of, again, makes me question, where are these guys at? What is their focus? How much have they been doing in this exact type of thing? The next concerning thing is that you start getting projected values of that have no supporting documentation that just seem like wildly optimistic potentially. I mean, maybe this $15.5 million hotel is realistic, but there's nothing in it to make me think that, or to explain the story to me so I can really trust these numbers. And then when you start getting down to some of these equity multiples in the projects that have gone already, it's like, okay, so we created $450,000 of value from our purchase price to our sales price, but yet they're saying the equity multiple is over 20x, which, unless you're doing some sort of a thing where you had, $10,000 down or something, astronomically low, it's either this is an extremely unusual situation, or that's not repeatable, or they don't understand math and that there's something way off with this. So a lot of things, again, with this slide that just make me concerned with this, and not really trust that I can believe everything that's in here. A couple of case studies that they show, projected valuation. Again, what's that projection valuation off of? If it's something like you just had a refinance and opportunity, and a bank accepted that, that's one thing. I mean, but if it's just something that you got an opinion from somebody, or you made up the opinion yourself, that may not be of a whole lot of value.
Okay, these case studies are basically just taking what they saw on the table and putting it in a new slide, basically, right? With a picture.
Yep, exactly. Yeah, so these are the bottom 3 that they're, well, it's actually, this one is the first one. So this one's still in portfolio. And then the next 2, this is one of the hotels that is the second one up here. And then the final one is one that they've actually sold and done that way. But again, not enough detail there to really give you the idea. The other thing with this is that, especially when we've had a period of time where you had rapid cap rate contraction that expanded values that we saw from, say, like things that were bought in 2018, 2019 or before, that then maybe were getting sold in 2021, 2022. You really need to know sort of the timeframes. So like with this one, the Revel Apartments, it tells me up here that was a 4-year hold, but it doesn't really give me the idea of when that was, because you want to understand, is this value that was created, if this is even real, is this something that is directly because of the ability of this team to pick a good project, to then implement everything that they plan to do, to execute on it, and then to sell it? Or is it something that they just, got lucky, where they bought something and then cap rates went down while they owned it? So possibly it's a good thing, but at the same time, it makes it, there's just not enough details here to sort of know what's happening. Then we get into key terms. So now, again, what we're offering. So another thing that shows me this isn't a fund is that, they're talking specifically about the purchase price of this one specific asset. So if this would be the type of thing where if this was a fund, they would say that, hey, we're raising a $15 million fund. We're looking to have this many different assets. This is the first one. But in this case, they just keep mixing back and forth as to what this is. Then the next thing here is you've got your target net average annual return. 25% if held for 2 years and 16.7 if held for 3. Really what they've done here is they've just put a target net equity multiple for you, the LP, of 1.5 times. And they're saying, we don't know if we're going to sell it in 2 years or 3 years, but your average annual return is going to be drastically different because you're going to make the same amount of money no matter how long we have this. They also, with this sort of thing, there's no place in here where they're giving us what the splits are or anything like that. They're telling us their preferred return, but you really want to understand, you know, what the team that is implementing this, what kind of fees they have, what they're making along the way, and then how they're going to get paid versus what you're going to get paid. And this is a very basic deck that doesn't give you any of those sort of details that you need. Then we get into a couple of examples here as far as what does the projected things look like. Another thing that makes me concerned is there's no place in here where they've shown me what my cash on cash expected returns are. They're really just making this seem like, oh, we're going to give you the 8% preferred return, which is possible if they've got call it a 12% cash flow coming off of this project, and they're going to pay me out the 8% pref each year. That's very, very possible. But in this case, they've done nothing to make me think that that's the case. And instead, what I think it is they're just basically making it seem like they're paying that out. And so a lot of this stuff just really doesn't give me any confidence. This is just their 2-year example. Then you've got the same kind of numbers, but you're coming into a 3-year example, for their other thing. Then this slide is really just sort of a fake, I don't know, theoretical thing that if you started with a $100,000 investment and then every year they had another one ready to go and you kept rolling it forward to where all of your profits from the first one came out and then immediately went into another one that they had available for you, and it was the exact same return, and you just kept rolling it, that you would get this sort of a equity, multiple amount after the 12 years. So again, it's really just made up, and I don't see any value.
There's no backup for this. There's no track record, that supports this kind of stuff that you saw, everyone saw there in the last 2 or 3 slides. You are not going to see that in a good sponsor's deck, flat out. That, I mean, it's blatantly obvious in this deck that these sponsors are they may have done okay in their deals, but they really are not sophisticated. And you don't want somebody to be learning on your dime. So you're just not going to see this kind of presentation from a seasoned sponsor.
The other thing that is a key thing lacking, besides showing splits and fees and any sort of real plan, is what's the debt? What are they doing that way? Because the debt is your biggest partner in a project like this. And so you want to know, is it fixed rate? What's the rate? Is it variable? If it's variable, for how long is it fixed for? Is it interest only? Just all of the different metrics like that. And they just have completely ignored that portion of it. You don't know what the debt service coverage ratio is. You don't know any sort of projection. So that's why we went with this deck, as one that is just lacking in so many ways, and really a very unsophisticated deck that makes me think that these guys are just really new, don't really know how to put something together, and in no way would give me confidence to give them any money at all, no matter what their projection showed. Yeah, the other thing that we did on purpose is that both of these decks that we're looking at are not things that are currently being raised for. They're in the past. And so it's something that we didn't want to have you guys see something that, especially on this next one, where, it could be seen as I'm saying it in a favorable way. We didn't want to have anything that made it seem like we were giving advice to invest in something, or like the last one, not invest in it. So both of these are decks that are in the past. Let me share this next one then. This is one that was submitted from last time, and I chose this one because it's a very good deck, and so we, like I said, we do need to get the people that are the operators to sign off and sort of release us when we look at these things. And this one was pretty easy to get for two reasons. One, I actually know this person. Hans does too. I think, Hans, you've actually invested with them in the
I'm
past.
invested in this deal.
Okay. Oh, even more. So you may have some really good comments as we go through here then, because you probably know this a lot more than me. I know the operators of Vantage Point Adapt, but have never invested with them. And so I think it's something that I kind of knew them ahead of time and respect their work. They've been around a long time, have a lot of experience. Okay. So again, just like the last time, the front page gives you a little bit of an overview of what you're looking at. So we've got two apartment complexes. We'll get into it. They're actually not right next to each other. Sometimes though you can have a two-pack deal that's right on top of each other. Other times they can be a long ways apart, but you just want to get into that. But this is giving us that there's a total of 221 units. It's going to be in two separate units. They're both in this Fayetteville, Georgia market. And then the other thing that they're telling us is a key thing is that the loan is fixed and that they're assuming it. Again, we've got two teams here, and then we just want to figure out as we go through this how they interplay and what the look of them are that way. One thing that I would say off the bat, though, since they have very similar looks, I would say, okay, they probably have been working together a long time if they're not under the same umbrella.
The logo seems similar, so I guess it's the same umbrella, right?
It's one and the same.
Yeah. Basically, as we get into the narrative down below, you'll find out that one existed to begin with, and then eventually the other one came about, and they just sort of absorbed them together. So this is where we first get into sort of telling us about what's going on with these specific properties. We've got two properties that are not too far apart from each other. They're giving us what the average rents are, the total number of units, and then the construction time frame as far as when each one was built. So this one is 113 units built in 89. This one is 108 units built in 93 to 95. A little bit of information or a look at each of them. And then what we start here with is this deck, by contrast, has some of the most detail as you go through it. There's a ton of verbiage. There's a lot of explanations, much more than I usually see in a deck. It's really nice because this deck, it's 65 pages long, but it tells me the entire story. There's only probably 4 or 5 things that I don't know very clearly as to what their plan is and things like that by the time I'm done. So it's really nice to see something where you've got all of the deal structure and just sort of a clear picture of what they're looking at here. So not to get into too much of the details, but they're kind of talking about how much they're buying it for, what costs are going to be, what renovations are going to be. They're even getting into right away talking about, insurance and reserves and all that kind of stuff and what the equity requirements are. So now what we know is we know that they're raising $21,047,000 for this deal that they're doing, which is these 2 units. The other thing that's interesting to look at here is that this is a regulation 506B. So this is something that they are not allowed to send out to people unsolicited, but they can also include a certain number of non-accredited investors. So you'll see this where a lot of the things that you're getting where you are seeing it online or, it's kind of more blasted out there is only going to be the 506C, where everyone has to be an accredited investor. In this case, you would have to know somebody or be in contact with these guys from the past and get on their list before you would be getting hold of this deck. Then what we get into is an ownership structure. So we're really seeing, how DAPT, and then they have created an LLC that's going to be the sole owner of both of the 2 LLCs that will own each property, and how that flows down. So it's something where just, again, a lot of detail that you normally wouldn't see as far as the structure on it of how everything's set up and what's in place to sort of keep everyone protected that way. With this, then we start in.
can you touch on when so in this case, they create an LLC that owns the individual properties.
Right.
Can you touch on when would it be a case where, because like for the next buyer coming in, can they buy the LLC so the tax is not reassessed? I see sometimes like the new buyer buy the whole entity versus they have to create a new one. What would cause that change?
The only reason I've done that in a deal where you bought the LLC and it was to avoid transfer taxes, I think, in Florida. But it's not common in multifamily and it's not done that often. It can be done, but usually you don't want to buy something because there could be liabilities attached to the entity and you want to buy the asset. So it's very rarely that you do buy it. It happens, but it's not, I would say it's less than 5% of transactions that I see as an LP.
Right. The two things are the transfer tax, or the other thing is if there's a big step up in basis, just triggering that there's a taxable event where they're going to come in and reassess it are kind of the only two things that I've seen that in. But Kathy, in this case, they could sell these individual Town Crossing or South Point as an entity to the final buyer. One or both of those, which is most likely what they're going to do, or what you're talking about. They could also sell the LLC that owns just South Point, or the LLC that just owns Town Crossing, or the LLC that owns all of those. But yeah, it's unlikely, I would say, in this type of a deal.
Thank you.
Any other questions so far on?
I think we should get into we should get into the deal like 10 minutes in, and we're at page 8. So
okay,
we should dive into it.
Yeah, so then this is a great overview of the opportunity and the plan and key details. So I won't get into too much of it, but it's really telling us here where, we've got our loan details. So we know that there's, it's a Fannie Mae loan. They're doing an assumption. There's 10 years remaining on this one for South Point. It's a, interest rate is fixed for that entire 10 years at 3.61%. We've got interest only for 36 months. Versus the other one, it's also a Fannie Mae assumption deal, 7 years, and just all of the details. So they're really clear on this. You know exactly what you're getting into and what the plan is. Purchase price, cost per unit, loan to value that you're looking at. So a very reasonable LTV, telling us what our cash on cash is going to be, the expected IRR and equity multiple, hold period, all this kind of stuff. So verbiage, but then also just kind of a key information.
I have a question for the two of you guys, just on that, because it's important. Because we were talking before on the previous one about a fund, and this is it's not a fund, it's a portfolio, right? Because you're buying two properties from the get-go, so it's sort of different. But this is an example of where the first property, from a loan perspective, is better than the second, right?
Right.
And so, the diversification here, maybe the performance, we'll see that in a second. But from the loan standpoint, like I'd prefer to invest only in the first one, not the second one.
Yeah,
and looking at this on a loan standpoint, you got to look at the entire
100%. I'm just saying, like an example of buying two properties at once, you're diversifying. There might be other stuff. I'm just saying.
You need to know why they flow well together. And that may be that it's just that there's economies of scale, or something like that. It could be that one of them has more of a value add component. So you might have two deals that you put together, and one of them is going to be more of a cash flow play, and you're going to get some cash flows right away. And then the other one, you're really not going to get much out of it because there's such a heavy lift, but then you're going to get a higher equity multiple down the road. So again, there's nothing right or wrong with it. You just want to understand, why did the operator put these two together?
Did they say that? Did they mention that? Did they mention that in the deck?
Yeah, basically, they're buying this from somebody who has a lot of properties. These are the only two in this area, and they're doing self-managing, and they really haven't built out their team. And so really they're solving the problem of taking over both of the properties from the current owner, who is a very sophisticated and sounds like, from the way they talk about it, a very quality operation in most of the places, but they just don't have the presence here. And so these are sort of the neglected stepchildren of the portfolio that the new purchaser feels like there is a value add component by just coming in and focusing on it.
Perfect. All right, got it. All right, let's move on.
So property details, giving you all of the different, just so much detail on exactly what's going on, school districts, why it's great, what's going on with population growth, all the different types of things. This is where you're coming into who they're buying it from. They've got a 2,000 unit portfolio, telling you what kind of stuff they've been doing. They've brought things in-house over the last couple of years, and just very clear when you sit down and read this as to why they think this is a good opportunity, why this makes sense, and why their plan is gonna work. So just the level of detail to where that's in this deck is far beyond what I typically see, and very, very good. There's a lot to wade through. Next thing, talking about what they're going to do, what's been happening in the portfolio, what's going on in the overall market, how they think that there's a current loss to lease, as far as being that the rents that are charged on average are significantly less than what the market could bear. In a later slide, we'll see a lot more detail to explain that. But again, just really a great explanation of what's going on with this. Then they come into this. Ashley Oaks is something that they have run and has done very well for them over the last year and a half. And it's not in the same submarket, but basically what they're trying to do is explain to you how they've done projects like this, why it worked, and how it's going well. Getting into
I have to say just one thing. All right, this might be a really good deck, but it's like so much words. It's like hard to go through, right? We should maybe skim through it.
It lacks, and that's one of my complaints, is there's a couple of key slides that I like to see that outline and put this stuff into a very clear spot, and this deck does not have that. And so what I would like to see would be a couple things like that really outline it, because a lot of people are going to get bogged down in the words. The good thing with the words is that the whole story is there if you spend the time. The bad thing is that when you're scanning lots of decks and you come to this one, there's just a lot to wade through to figure out if this is a good deal or not, and what it is. So that is
where it comes to my point being on the last presentation. If you're investing $50,000 to $100,000, this should be treated as your second job, and you should be okay with reading lots of words. Because if you're not, you should not be investing. And I'm dead ass serious about that.
Yeah, so I appreciate all of this in here. The only thing I would ask, Hans, with a deck like this is
I get it. You want to be able to find some stuff. I get that.
Yeah, that where they're pulling it all out, and you can scan through and see the key points in one or two slides, and then you can get into all the words. And I think that would be an improvement. I would tell them,
like an exact summary. Yeah,
exactly. Where it's simple that way. So a lot more details on what's going on, why they think it's a good deal, exactly what they're going to do to improve the property, just a ton of information. Then we're getting into what they're seeing as the details of why they like the project, what's going on with it, all the different things about it that they like, the debt, and talking about, you come away with this, that there was a 20-year moratorium on building in this area. So there was nothing built between 95 and 2015. And so that's why when you come into their comps later, there's 5 comps, and they sort of walk you through that, but you start to understand that you only had 2 properties that were able to be built in this area, kind of in the same kind of time frame. And then there's been a couple since the 2015 moratorium was lifted. But again, lots of details on that kind of stuff. Telling you about the location, all the different things about the market, population growth, you've got not only these properties at 97% occupancy, but you've got the whole market is 97 to 98. So it's not something that's unique to this. That sort of shows you that there's more of a pressure in the area. So then we get into expected early return of capital via supplemental loan. So basically at this point in time, they're raising a lot of equity and to basically take over these 2 loans, and they're not doing like mezzanine debt or preferred equity or anything like that in the beginning. And so you just want to understand what this is. So they're kind of walking this through as to why they're doing it, what the time frame is that they think they're going to be able to do a supplemental loan. So they'll keep the original loan, and then they'll add in an additional loan on each property if the market works. The nice thing with this too is you want to know what happens if it doesn't work or if things change. And it really gives you all the details as to what the IRR changes and things like that if you're not getting some of your money back. Now, some people would say things like this are a negative because that means in some ways they're over raising and then you're planning to get your money back. So it kind of depends on how you're looking at it, but you need to understand that likely in a year, you're going to get a check, and they've got some details on it down below. And then probably in another year after that, 18 months later, you're going to get another check coming back with some of your initial capital in.
Hey, Mike.
Yeah.
Do they typically cover how an early return of capital may influence your preferred return? If it does, I know some of these refinances are structured very differently, and sometimes I have a hard time picking apart how that might impact my pref.
Yeah, so they should spell that out. In this case, and we'll get to that later, there is no preferred return. And so it's just a straight splits, on it, which is a little bit unusual, but there's no pref in this case. But I would say most of the time, Christopher, you're going to have to where when they're sending that back to you, like I have, for example, I just received an earnout on one of these where basically they went in with a loan, and then the bank made them hold money back until they hit certain thresholds in the value add component of it. And then after that was hit, then they released that capital to come back to us. The great thing is that now I'm getting 5%, 10%, something like that of my original investment back. And I am also keeping 100% of my ownership in that property. The downside is that if there was a significant acquisition fees or any sort of upfront fees, they've collected money on that, and then they're giving it back to you, relatively quickly. In this case, it's going to be, 12 months to 36 months in. And so it's something that they're kind of juicing the fees. And there's nothing right or wrong. You just have to know it.
On that, Christopher, your pref and a refi, they're not related. Your pref, you have to look at the waterfall structure, and it doesn't. Your answers to your question is defined in understanding how the waterfall works. It doesn't matter really whether there is a refi or not, and if how pref is affected by it. But what I'm saying is your answer lies in understanding the waterfall structure. And if you understand that, then no matter whether there's a refi or not, it'll be very clear when you get your capital back, and when in transactions when you don't get your capital back, and it's a return of operating profits, etc. If that makes sense.
Okay.
Yeah. And then, so then this slide, a little bit going through the risks, you do want to make sure that they've thought through risks, and then tax benefits. You want to know, are they going to do a cost segregation or not? Is that going to be something that they're sort of getting me more tax benefits in year one, or is it something they're planning to hold it long enough that they're not going to do that? I'd actually like a little bit more detail here. They give it later, but that's another point where they're not making it clear as to what they expect the tax benefits would be from a cost segregation study, which they can't know for sure, but I would like to know an approximate amount of what they're estimating. Then we get into sort of the two individual properties themselves. So, kind of an overview of it, what the buildings are looking like, different sizes, what the makeup of the 1 and 2 bedrooms, and then they've got the townhome one, but just sort of an idea. Something that's sort of unique with this is one of the two, and you've got it to where it's kind of split with actually what looks like some other properties in between, but they're all, close and obviously the same style, but not touching each other that way. Details on exactly what, you've got square footage, how many units, 1 bedroom, 1 bath versus the townhomes, 2 bedroom, 1.5 bath, that sort of thing. But telling you sort of what they've done, where they're at with 25% of the units have been renovated by the previous owner, and then what they're looking to do. this was a nice feature in multiple of these pages. There's these embedded, video tours. So you can click on that, takes you out to YouTube, and you get a 3 to 8 minute video of, the specifics in that where they're narrating it. And again, really letting you see the property and them talking through what they're expecting. And then a very detailed, thing of what they're planning to do. And so just so much more detail in this than what you would see in the last one. So examples of what the classic units are. So 25% have them not done, 75% of what the previous owner has done. One thing that I would say you got to be careful with this kind of thing is, did they do what has been done? Is it satisfactory to sort of get you to that market? Because what we'll sometimes see is somebody will come in and they'll kind of go cheap on the renovations, and they spent some money, but it wasn't enough to be able to get you to that next level of market rent. And that's one thing I'd like to see on this slide is they give me what the averages are, but I'd like to see the average on the classic units versus the renovation units to sort of see what those look like. Then they're talking about what they have done already with the current owner and then what they're planning to do to these. So at least it's something where they're planning to keep it black, and they're not saying like, okay, we need to come in and pull this out and put stainless or something like that in. Exterior of this property, same kind of thing, just a ton of details on everything that's going on with it. Pictures, and a good overview of what's happening, and then more improvements of what they're going to do, including some of the areas that they think need to be improved. Then we've got our next property, a good overview of what's happening there, what it looks like, all the details, average unit size, all those different details. Same thing with the interior, the same as the last one, where they're telling us what it is. So 45% of them have been partially renovated, what was done with those sizes.
Do they walk it, and Mike, do they walk into the average rent per each unit and stuff like that down the road at the end? So
they give you what the averages are, but they do later. I'll show you a slide that has.
I think we should we're like half. We have I want to leave 15 minutes at the end. We should get to that.
Yeah, get to some of that kind of stuff.
It's
Okay.
kind of the meat of it, Mike. I would show, how they show their rent comps. That's something everybody needs to see.
Yeah. So
It's
market
a very good
analysis,
example of the rent comp.
the area, then giving you some regional highlights of why this is an area, why they like, why they like it. This, I would say, is a better example of really being able to understand some of where the key things are, and where the two properties are located. So I like that, and that's a nice thing to see. Then with this, they're giving us, you really want to know the amounts of household income and things like that, what the rents are, school districts, everything for your whole area. So here they're kind of giving us that breakdown on a very local level, which is helpful, and showing us where the two properties are, some major developments. Then we're getting into the rent comps. And this is where they start talking about that there's 5 direct and talking through why. There's 2 of them are even a little bit better. And then telling us a little bit more about a couple of newer ones that have been built that don't really compare. They've included them, but they're much higher because they were built in after that 2015 moratorium was done. Showing you the where the different rent comps are located compared to these 2 properties with distances. So again, very helpful getting into so this is where we're getting into unit types, square footage, what the current rents are, what their plans are to go to rents, and then where they're at compared to the comps in that. And so this is where you're getting into a lot of those details. And then here we start getting even more specific, where they're showing us the unit size. So this is a 1-bedroom, 1-bath unit size and the amount of rent, and then the different places. So you can see, that these are a little bit bigger than these that were newer, but that, you're like at $900 difference in price. So this is sort of where their pro forma is, that's still well under the average for the market. And then you can see here where they've mapped out, you've got some of these that are actually larger, especially than the second property. The first property is sort of bigger rooms, But you just get an idea of where it's at, that you can figure out, does this make sense? Do their comps work? And there's more details on that later. So then the same thing with the 2-bedroom. Now's where you get into these 2 units and the specifics on them and notes with then sort of the different comps as far as what it is. So like one of the ones that they think is a good comparable, they tell you, you know, what the amenities are, when it was built, how big it is, the general location, and sort of why it's a good rent or comp. And so you can get some of these details here and then go back and look to see, okay, does this make sense to me? Does their plan work? And again, I really like how much detail they've given me. They're, you know, helping me to be able to then get a clear picture of why the different rents make sense, and why what they're projecting seems reasonable, with just the level of detail. Then what we actually get, which is something I don't see very often, but this is actually a unit by unit in-house rents of what, you know, the actual current leases are. And so you can see that, you know, current in-house rents are close to what they're doing for their, this is sort of where they're looking to get to before the renos are done. And then this is what they're looking for after things have been completely renovated. So you can see sort of where the most recent, because this is a timeline here, some of the most recent ones where they've been at, and it just seems like they're moving them up and they're still at 97% occupancy. And then you've got some really far laggards down here that are well under where it's at, that hopefully with time they can move those up and make a really big difference. But this is, you know, your rent roll on each of the different types, and you can see exactly what's going on with them. So great picture of that. This is the same exact thing for the next one. And here you can see what looks like one of their latest ones is actually above market and above pro forma by $189, and they were able to get somebody to pay that. So don't know what the story was there. More details. Then we get into the sales comps. So tons of detail on the different buildings and when they were sold, you know, what the details are and what the unit prices were. So they were coming into this at 161,000 a unit. And what they're saying is that when you look at all of these comps, that you're at 225 and that this one was under market at 200. So again, just sort of giving you an idea that there is some room and that there really is, you know, an idea that there's probably some room, some safety in this than where those comps are at. Now we're getting into financials. So with this, you know, you've got a ton of detail in the plan. So we know exactly what's happening, where all the reserves are, what the prices are going to be, you know, how much money's coming in. You've got your exit cap rate on the sale for what they're doing things with. They also are telling us, they didn't give us an incoming cap rate, but we can, you know, infer that because they do tell us in another place that they are doing a cap rate expansion of 0.1% per year. So they're actually, the incoming cap rate is at a 5.1, and they're looking at exiting at a 5.7 after the 6 years. One of my complaints is that they really don't show things like acquisition fee. So we see here they're going to make $1,066,000 on it, but they don't clearly spell out, is this a 1%, 2%, 3%? Like this happens to be 3%, which I think is pretty high on an acquisition fee, and they're not making that kind of stuff clear. But at least we're getting the details, but I would like to see a much easier slide to sort of get some of those key things for that. So this is the 2 loans coming together, and then all of this stuff is being financed by equity with that. Then we're getting into sort of spelling out what you're looking at as far as your annual distribution. So this is your actual cash flows. So in this case, kind of as Christopher brought up, we haven't found out yet, and we don't find out till later, but there is no preferred, you know, there's no pref in this. So a lot of deals that we see do have a pref. This one doesn't. There's a detailed slide later as to why there isn't. It also up till now isn't really telling us what our splits are, but you can start to see them because it is showing you down here cash flows and different things like that. We also have to come down here to see what the impact is on the depreciation, where they're saying if you were able to save on your taxes and took the money that you saved on your taxes and kind of added it back in, what that kind of compounded rate would be after that tax savings. I'd like to see that spelled out a lot more, where they're making it clear as to what their assumptions are on the amount of depreciation that I'm going to get that way. But at least I've got a lot of detail here on how that's all looking. Then we've got details on, debt service, cash to distribute, and you can see here how much is actually going to the operator versus how much is going to the LPs as it goes across. And again, they didn't tell me this, but if you start checking this out, this is an 80-20 split when it comes in through here. And then this is a little bit skewed because basically they're saying you're getting your money back. And so this makes it look like it's like a 91-9 split, but really that's just because they're giving you credit for the initial.
One thing I'd like to point out here is if you look at the operating summary here, you can see how much they are showing as cash distributions to investors. And you see how they got to that number, okay? And if you look at that 778, then you go back and look at amount of capital they're raising, and then you look at the slide that he just went through where it shows 3.7% year one to investors, it ties out. So you actually know that, okay, you looking at their P&L, they actually tied out exactly to the 3.7% that they said investors would get year one, meaning they're not raising equity to pay back your equity here. And there's actually an NOI that produces the cash flow that's giving you the cash flow percentage that they're showing in the previous slide in their $100,000 example. So it's things like that you got to pay attention to and kind of make sure you tie out, because many times you could show distribution here and they could be using cash that they raise from you to make the distribution if they don't give you details like this.
Yeah, the other thing with this that I would show is that their effective vacancy is extremely conservative. This is a properties on average are currently at 97% occupied. They're telling us the market is 97 to 98, and they've got even at 6 years in that you've got a 7.5% vacancy rate. So another point where it just seems as though the assumptions that they're using are extremely conservative. So if anything, their IRR is probably on the low side versus what they're going to actually achieve. This is something where normally I would see the management team slide a lot sooner and I would get some bios. This doesn't give us anything. All we have basically is this hyperlink that you can go to. So maybe that's to save space since we're already at 65 pages. But that's something that if I was going to invest, I'd want to dig in and look at it and to go through that. So you want to understand who these people are and what's going on that way. What's happening with these advisors. They gave us some details there. This is some of the properties that they have under management. And again, you've got a hyperlink to go to the full amount or the full portfolio of things that they're currently managing. But you can see that they are, they've got a number in Georgia, but they also have some things in Florida and some other states too. And then this is sort of their timeline that they had into the initial thing. And then additional information. This is where I don't often see this detailed of an FAQ. They've got multiple pages of the FAQ that kind of talks through that stuff. But I'd like to see, like we said, key details and sort of all the fees spelled out in a slide much earlier than this. We really had to dig into some of these FAQ answers to sort of get some of those basic things. But why they're selling, how the deal is structured, what happens with the return of capital, what amount to expect it would be, different things that way. And then they're really not giving us what our splits are until all the way we get down here. And again, that should be a lot easier to see, but there's no pref and it's an 80-20 split from the very beginning. So, even before you get your money back, they are taking 20% of it. And then once you get to an IRR over 16 on the sale, then at that point in time, then it's going to go to a 60-40. That's a little bit earlier than what I would like to see, but it is about where their pro forma is. And so they're probably saying, okay, if we are going to perform, significantly better than what we're saying we're going to do, then we're going to double our take after that point in time. But
just like to our conversation, like the last week, in the beginning of this conversation, of like the beginning of this session, this is it's an experienced GP. Like they've done a lot of deals that have really good track record. You can see by the deck that it's really well, like good. It's a good deck, articulated correctly, and that's why they can afford to have different. I wouldn't say more aggressive, but like more GP friendly terms when it comes to the waterfall, which it's fine, right? If you saw that with the previous deck and you'd say that's a first time operator and this is what they're offering, that's another red flag. It's really important to.
It's all about, it's a combination of things. You're entirely right. It's a combination of their track record, how good a deal you think this is, all these factors, and then the waterfall should not be used as a single decision. It's a data point, just like anything else. Exactly. And I'll gladly pay a strong operator or a strong sponsor. I want them to hit a home run and get super rich on the deal, because that means I did well. And I'm totally 100%. Fine with guys getting paid for creating value.
I totally agree.
So now they're finally telling us they don't have a preferred return and why, giving us very specific things on the loan. One thing that I would say is they do talk about the two of the principals are signing on the loan, but they're both non-recourse. And there is, I think it was a $200,000
1%
signature fee, which is a little bit high for non-recourse, I would say, but at least they're spelling it out. And then different assumptions that have gone into things and who's going to be managing it. So this is another thing that's really important. Up until now, we haven't seen a lot as to what's happening, like with this. So now we're seeing that this is third-party management, but it does tell us that they've been working with it for a long time. They're managing 26,000 units. It sounds like they're using this group pretty well exclusively, and that they've got a lot of experience in that area. But that's something not to gloss over, that you really want to make sure who's going to be operating this, because that's going to be a lot of whether this works or not. Then they start getting into things like what if values go down, what if rents go down, what if it's not a good time to exit, different things like that. So yeah,
Mike, did they include a sensitivity analysis at all?
They did not.
So okay.
That's another thing that would be great to see, Christopher, is what happens if they have higher or lower occupancy? What happens if rents are higher and lower than they're expecting? And then also, most important is, if the cap rate isn't the 5.7 that they've planned on, what if it's a 5 versus what if it's a 6.2, to see that. But that is something that I would probably ask for if I was going to invest.
Yeah. And this is the type of sponsor that would provide it. He's actually going to start adding it to his future deals. He mentioned to me a while back. So, because I mentioned that it's not in there.
There's certainly no lack of data, so I wouldn't hold that admission against them.
No, there's not.
Yeah, like Litan said, if anything, it's too much and it's sort of overwhelming. But I would much rather see the operator spell everything out and that they have thought it all through and telling me exactly what their plan is in the deck ahead of time versus the first one where it's fluff and, like you get one sentence that just sort of, tells you a little bit of what they're doing, but you don't really have any clue if they've really thought through their plan. Hans and Litan, anything to kind of talk through with this one?
No, I think the reason I provided this deck is because I think it's a very good example of a comprehensive business plan. There's always going to be items that I may have mentioned in my prior talk that may not be included in every deck. Everyone has different decks, but I can promise you that a sponsor like this, and I personally know this one in particular, but even without knowing him, after reading in this deck, he's done a sensitivity analysis. He even mentioned sensitivity to the free finance, right? In the deck. He's done it. He just doesn't put it in his deck. And so things like that, you can just always ask for. A sponsor like this is obviously very transparent because he's trying to put everything possible into his business plan. So, and he told me, he said, after, you guys talk about it, I want to know areas of improvement. So you know he's a good sponsor when he's spent years doing this and he's still looking for feedback. So I think this is just a really good example because it lays the biggest reason I love this deck is it lays out in detail what the value add strategy is. And after you're done reading it, and if you really read it and understand the charts, you really can get a good grasp that there is a true value add strategy. That's my favorite part of this deck.
Right.
I feel like this type of deck is one of the reasons why I'm a passive investor. I find people I can trust and I invest with them. And obviously I want deals to work out and I want to make sure I'm protected. And this is really important to go through this deck. But this is a great example of like why I'd find someone I trust that understands this. And let's just say Hans, and you go over and you say, this is a good deal. I'm like, all right, I'm not going to read it. I just trust Hans. So it's like, because this is like one of those.
That's a
No,
bad
I
idea.
agree.
Don't do that.
I agree. I'm just saying that like this is one of those decks that I think the vast majority of like standard LP investors, and I'm not saying it's a good thing. I'm just saying probably wouldn't read the whole deck.
Probably right.
I would
And
hope they would.
what?
Because one of two things: either you're putting in so little to your net worth that it's not going to be consequential if it goes good or bad, or if it's a substantial amount of your net worth to where it actually will move the needle to some extent. Call it 1%, 2%, or especially if it's more that then of your overall net worth. You absolutely should be reading it all, and not only reading all of this, but this
You
is
turn
just,
it on.
then you need to read the operating memorandum, and you probably should look through the PPM to look at other things with that too. So it does take a lot of time. This is going to be a 6-year commitment that you're in this, and you're going to spend most of your time up front deciding, are you in or out? And what I like is I look through tons of decks like this, and then I know, is it something I want to look at more and spend more time on or not? And this is one where, Hans, like I said, my biggest complaint with this is that you have to read too much to sort of get those key things. Does this make sense for me? And am I interested? And I'd like it to be a little bit easier to get kind of those snapshots. But then I love all the detail that's there, because then that tells me if I like it, that then I can start digging in more and answer a lot of my questions then.
If they converted this to a power like a proper deck, like a presentation, it probably like 500 slides. So I get why they did a document like this. Yeah,
it's unusual.
Yeah. Well, anyway, I mean, this was great, Mike. I mean, I think it's a very good contrast between one side of the spectrum in terms of a decks and the exact other side, like full scale, I think. And it's really interesting to see the differences, and obviously the pros, cons, the red flags, and the advantages of this. Are any questions of like what like about this whole session before we sort of sum up the key things that we want to look into when we go over this? Just to remind.
I have one general question about waterfalls. A lot of these deals are pretty straightforward. They're not difficult to understand, but I have seen some waterfall structures that get complicated where there are multiple hurdles over some period of time. Any general tips or maybe pitfalls to avoid when we see these kinds of complicated waterfalls?
I would just need to make sure you understand it and to know, that you understand where it is and who's getting paid when, and that you're okay with it. I've had people where they just didn't pay enough attention. They saw that it was initially an 80-20 or 70-30, and they didn't look beyond that only went to a 14 or a 15 IRR. And so you just have to think through that as to what they're projecting. So if they're projecting a 15 and the waterfall changes at 16, well, then that may be realistic if you're okay with that. But if they're expecting a 20 and it changes at 14, then you have to think, okay, they have to really do a lot more earning to get me to my 20. So how realistic is that? And then there's the concern that, are they taking on more risk? Is there more debt? Is there more, something that could go wrong to sort of hit those higher returns with the splits to the operator being higher? But
yes, please. Thank you.
Well, general rules.
Han, did you want to add anything to the waterfalls?
No, I mean, I don't think there's plenty of there's millions of waterfall scenarios out there, and the key is to understand how they work and to make sure you're very clear on how they work. As Mike said, I don't think there is inherently a downfall or something bad because it's complicated at all. It's really there's so many structures that it's really kind of a blue sky question. And without looking at a particular structure that maybe you're referring to, I believe that was Chris that asked the question. It's hard to answer your question directly without looking at a particular type. There's just too many. But I haven't seen, there's not like a type of waterfall that's bad, if that's which kind of you were getting at.
Okay.
Because for the other thing that I do a lot of times before I invest, if it's something that looks interesting, is that I'll look at the deal level returns, and then I'll put in an Excel sheet and flow it out to be like, okay, if the deal level returns an 18, what am I going to get? If it's a 20, if it's a 25, if it's a 30, if it's a 10, and then I can see how that all flows to me. And that's something that before I invest, especially if it's a complex deal waterfall, I'll always map that out. And then what I can do is say, what's the likelihood of the type of project that they're investing in at the deal level getting this type of return? And then see what they're telling me, is that seem realistic?
And I assume that's something that just comes with experience on you determining how realistic their projected outcomes are going to be.
Yes. And the other thing is that I'm not going to know as much as the sponsor. If it's somebody that I'm going to actually invest with, they're going to know far more about it than I am. So really my job is to more vet, does this sponsor know what they're doing? Do they know this project? Do they know things like this? Do they seem to have a good plan? And then what I'm doing is I'm coming along after that and looking at it to see, does this make sense? Versus, to be honest, with the first deck, it's just, I get into something like that and I just don't have any confidence, and I don't want to go in and figure it out. And so I just move on. And so the majority of decks, I just, do a quick glance at them and I just move on. And there's not any one specific thing, but it's something where it's just your overall feel. Is it worth me spending more time on? And then if it's something I'm going to invest in, depending on how big of an investment and what we're looking at and how complex it is, I had an investment that we did this year where there was 8 or 9 of us reviewing it, and we spent months digging in because it was very complex. It was kind of a new area, and there was a lot to review. And so you have to kind of know that, like a pretty straightforward multifamily thing like this wouldn't take anything close to that. But you do want to, check out some of the things that they're talking about and make sure it makes sense.
I have a question. So based on the deck that was presented, the second one, the acquisition was $1 million, about roughly that much.
Yeah.
And what would make you feel comfortable with a co-investment?
Yeah, that is
Like,
something that they didn't talk about is as to what the co-investment is. I don't know that I have a specific thing, but you want it to be substantial. In this case, because it's a non-recourse loan, they don't have that where there's a personal guarantee. That qualifies for some, but I would want to see that the principals are investing in a significant amount or have a reason as to why they're not with it. But Hans, do you have any rule of thumb? I don't really.
I have a little different opinion than most people do on this, Kathy. A lot of people are like, well, how much did you invest net of your acquisition fees? And I think, quite honestly, I don't agree with that question, and I don't care. When somebody's being a sponsor and doing it full time and they have a long track record, and they obviously know what they're doing and it's their entire job, that is how they make money. So if they make an acquisition fee and then invest $100 grand, that's a significant amount of money, regardless, to me, just because they made an acquisition fee. And you don't know that $1 million acquisition fee, he has employees. I know he does. It's not used, didn't just go into that one person's pocket, right? And so a lot of people are like, well, you're not really putting skin in the game if you don't invest. If you get a $200,000 acquisition fee and you have to invest $300,000 just to count as $100,000 investment, I don't agree with that at all. And I don't care about that. I'm much more interested in the business plan. I'm much more interested in the track record of the sponsor and getting to know that person than it is how much skin in the game they're putting per se. And yeah, they should they invest some money? Of course. But I'm not trying to equate it between the acquisition fee or anything like that.
The other thing I would look at is how big is their team and how often are they doing deals? There was one of the things in here that showed that they did a full underwriting of 203 deals before they chose this one. And so there's a significant amount of time and effort and employee manpower and things like that to go into it. And so if they're being more restrictive, and it's one of these places that really is looking at, call it 2,000, like 2,000 deals come along, and then of those they throw out a bunch of them, and you fill it down, and then you've got 204 that you have done a full underwriting on, and some of those you've done LOIs on, and that kind of thing, and then you come down to this one deal. That's being restrictive enough in what they're choosing that the fee doesn't bother me as much as one of the operators where it just feels like they're just buying stuff all the time. And it really, they're not being as discerning in what they buy. So I think when they brought this one to market, they hadn't bought anything. I hadn't seen a deal from them in probably 9 months or a year. Hans, do you remember?
I don't remember, but I know that they have not bought a deal. They've not bought a deal since this deal. And that was a year ago.
And so that's another part of it that, so would I say that the 3% is high? I would. And would I say that 1,066,000 seems high? I would, but at the same time, like Hans said, you've got to really look at it in the whole scheme of, does this make sense for what they're doing and how often they're getting that money, and what they're going through to kind of find me the best deals.
Thank you. Yeah.
But that's a good question.
All right, Mike, I think that was a great summary of this session and that deck. And I think maybe we'll just go around, like Hans, you want to give a sentence, to sum this up. What do you think? What are the top 2 points you think people should go out of the session remembering when they go into deals or go over decks?
Use my checklist that we sent out and use that as your guide to look through these decks. And if not all of the information, like I said earlier, that we've talked about, that Mike and I have talked about, or in my checklist, will necessarily be in every deck you get, but you should be able to ask the sponsor and get that information. Right. I even admit, I bet you go look at past my decks, and I may have missed certain things back in the past, and I may still miss them now sometimes. And so, but I will give any information that's asked of me, and that's what you should never be hesitant to do, is ask questions of the sponsor and make sure that they're transparent, and make sure you understand the value add plan. That's really number one. Learn to trust. Learn whether how to vet a sponsor and whether or not you trust that sponsor with a track record and the way they answer questions and the way they present themselves. And then 2, is there a true value add component to the deal that you understand and that they articulate clearly?
Right. I think I also agree. There's 2 things, main things. One is the sponsor, operator, syndicator, whatever the name of that organization firm is, and then 2, it's the deal itself. And obviously they're intertwined, right? Because if a sponsor has based their credibility, their transparency, it also helps understand if it's a good, bad deal, because it's related. So for me, it's I want to see all the check boxes that this is a good sponsor. They know they have experience. They're presenting things coherently, transparently. Yeah, I've heard sponsors who won't share their track record, which is a super red flag. And they're even when you ask them for it. And then the deal itself, all the things you guys went through, I think it's super important and interesting. I think this was, again, I personally, I've done a bunch of deals and I've learned a lot, even just speaking with Mike and Hans, also the podcast we've been doing and this workshop. I think it's the first of many workshops we're going to do. Hopefully this has brought value to you all. Feel free to reach out to us. Mike and Hans's information is in the email. We're going to share more, just the contact information. You want to reach out to either of us to learn more and be just better investors and make less mistakes. lower our risk and make higher returns. I think that's like the key. And we're going to share this recording as well with everyone who signed up and registered. And in the meantime, good luck with everyone in your investing career. Keep your passive investing passive, but make smart decisions doing so. Don't be lazy. Go through the checklist, go through the deck, read out all the important information. And, you know, rule number one of investing is don't lose money. All right. So good luck with that, and see you guys around.